Capital budgeting is the process by which firms make capital expenditure decisions. This chapter concerns itself with what methods and criteria are used by firms to make those decisions. Capital expenditures involve an investment upfront, a negative cash flow, followed by positive cash inflows, representing the benefits of the investment. To calculate an investment's payback period, take the initial investment and accumulate the net cash flows from the investment year by year. Net the negative cash flows and the positive cash flows cumulatively until you can determine when the cumulative cash flows turn zero. This would be the amount of time it will take for the investment to pay back the initial investment. Sometimes this calculation generates fractional years. The payback period method appeals to one's intuition in terms of what they believe a good investment should look like. It does have flaws, however. The payback method does not take into account time value money. Future dollars are given the same weight as present day dollars. The payback method does not provide an objective way of determining when the payback is adequate. The payback method ignores cash flows generated after the payback and will favor investments with strong upfront cash flows as opposed to those that generate more cash flows further out. In this example, if you invest $1,000 in an asset and it generates $250 per year over the next 6 years, the payback period is 4 years. 1,000 divided by 250 is equal to 4. One issue is that, for example, if payback is at 3.25 years, is this adequate payback or is it insufficient? The minimum acceptable standard could be 3 years. If that's the case, then 3.25 years is too long. However, if it's adjusted upward to 4 years, then 3.25 years is satisfactory. The arbitrary decision in terms of what the minimum acceptable standard rule is quite problematic. The net present value method sums the present values of all investment cash flows, both negative and positive, over the project's lifetime and generates a value that is either negative or positive. Sum the present values of the individual future cash flows at a chosen discount rate, netting positive and negative cash flows. The I, or discount rate, is determined as the minimum acceptable rate of return for the investment. The resultant sum is the net present value of the investment. The decision to invest in the project or not is determined by the value of the NPV. A positive NPV means invest in the project, whereas a negative NPV means do not invest in the project. A best practice would be to create a cash flow timeline showing when cash flows are realized over the lifespan of the investment. The net present value method is the most reliable of the investment decision methods. It makes full use of time value money concepts. It takes into account all cash flows. It measures the value created by a project. The NPV profile shows the sensitivity of the NPV to changes in the discount rate. Set NPV values on the y-axis of the graph. Across the x-axis, show the discount rate going from 0 on the left and rising toward the right. The resulting graph will show the NPV at different discount rates. This is demonstrated in Figure 16.2. At some point, the NPV will cross over from positive to negative. The inflection point between positive and negative, i.e. when the NPV is 0, is the project's IRR, or internal rate of return. The internal rate of return calculation works off the same calculation as the net present value method. The net present value method asks what the net present value is at a chosen minimum rate of return for that investment. The internal rate of return asks what rate of return will result in a 0 net present value. The two methods work in exactly the same way and will yield the same investment decision. The decision criterion is if the IRR is greater than the minimum rate of return for investment, the project should be undertaken. And if the internal rate of return is less than the minimum rate of return, the project should not be undertaken. If done by hand, the internal rate of return calculation can be tedious, as it is an iterative process. You would discount a projected cash flow stream at different discount rates until you find the discount rate that equates the net present value to 0. If the net present value is too high, you would raise the discount rate to reduce the NPV, and if the NPV is negative, you would lower the discount rate to raise the NPV. Through several iterations, a discount rate that equates to net present value to 0 will emerge. This will be the investment's internal rate of return. Using Excel and a financial calculator to calculate internal rate of return. Excel functions and a financial calculator greatly simplify this process. Excel has an IRR function that requires as inputs the projected cash flows in the proper sequence in order to calculate IRR. This input would take place by the cash flow functions of a financial calculator. Considerations using the IRR method. The IRR calculation will yield a rate of return in percent, which can be compared to the minimum required rate of return. In addition to being tedious to calculate, there may not be a single mathematical solution to an IRR problem. Two IRRs are possible. The multiple IRR problem. If the investment's cash flows are abnormal, meaning there are too many switches and signs and the cash flows are negative, positive, and vice versa, the calculation can yield two IRRs, both of which are correct. This does not happen when cash flows are normal, i.e. only switch signs once. This happens rarely, but is not a fatal flaw, one that would lead to concluding the IRR cannot be used. The reinvestment rate is an implicit assumption that the calculated IRR for a project is also the reinvestment rate at which the intermediate cash flows are invested. This assumption might be unrealistic or overly optimistic. You may not recognize immediately that the inputs for the NPV and IRR methods are identical and the two methods are not actually different methods but one and the same. The NPV method solves for a net present value given a specified discount rate, while the IRR method, using the same cash flows, solves for the discount rate that would generate a zero net present value. If you use the financial calculator in the cash flow function, this can be demonstrated clearly. You enter the cash flows using the cash flow buttons the same way for both methods. To solve for NPV, provide a discount rate and then press the NPV button. Without having to input any numbers or do anything else, press the IRR button and get the IRR. So IRR and NPV are not different methods, they work off the same data. They generate different results, one in dollars and one in terms of rate of return. They both give the same answer to the question, should this investment be made? The probability index is calculated by dividing the NPV by the project's initial investment. It is the ratio of the benefits of the project divided by its initial cost. The discounted payback method is an adaptation of the payback period method. Instead of simply adding up dollars across the lifespan of the project, regardless of whether they are future dollars or present day dollars, future dollars are present valued and then summed. This fixes the payback method's major flaw in that it does not take into account time value money. The discounted payback method still leaves two issues which aren't resolved. There is no objective criterion for making an investment decision. Once the discounted payback method reaches payback, it ignores all cash flows past this point. The MER, or Modified Internal Rate of Return, is the internal rate of return calculation that assumes the calculated IRR for a project is also the reinvestment rate at which the intermediate cash flows are invested. This assumption might be unrealistic or overly optimistic. To fix this problem, the Modified Internal Rate of Return takes the intermediate cash flows, the ones between the initial investment and its last cash flow, and moves into the last period of the investment horizon at a reinvestment rate that is fixed. If your project has initial investment in time 0 and 5 more cash flows in year 1, 2, 3, 4, and 5, the cash flows in years 1 to 4 are compounded forward to the end of year 5 at a fixed reinvestment rate. The result will be that the investment is boiled down to two cash flows, one in year 0 and one in year 5, making it possible to solve for what's called the modified internal rate of return. This becomes a matter of solving for either the interest rate, given the future value, present value, and number of periods. If projects are mutually exclusive, the exclusion of one excludes the execution of the other and vice versa. In this case, the decision which project to undertake comes down to which project generates the highest NPV. The NPV measures how much value a project creates, so choosing the one with the highest NPV also means that the project creates the most value for the firm. When projects have different lives, the investment decision becomes a bit more complex, as the investment horizons for the projects don't coincide. There are two possible approaches to this problem. The replacement chain approach would take the project with a shorter investment horizon and string as many of these as necessary to match the investment horizon of a long-term project. The investment decision would then be based on which alternative generates the higher NPV. The equal annuity approach takes the NPVs of the alternative projects and converts those NPVs into annuity payments. This is the equivalent to solving for PMT given PV or then the NPV and the number of periods and now the discount rate. The resultant annuity payments are then compared and the project that generates the larger payment is the one chosen. When projects are of different scales, i.e. the magnitude of the initial investment is different, one cannot compare them directly in order to make an investment decision. The way to approach this way to calculate the probability index and compare the results of the calculation. The probability index calculation will take the NPV of the project and divide it by the initial investment. This is the bang for the buck calculation. How much value can an investment dollar generate? Projects can be ranked in terms of their ability to generate value per investment dollar. Firms face limitations on how much they can invest at any given time. Resources are limited for all companies. Similar discussion on how to make an investment decision when project scales are different. Investment priorities can be set by calculating the probability index, and projects can be ranked in terms of their ability to generate value per investment dollar. Probability index is calculated by taking each project's NPV and dividing it by the project's initial investment. The ranking that comes from this assessment then becomes the basis for deciding which projects to undertake. Using Excel to calculate NPV consists of taking the project's projected cash flows, discounting them to today, and then summing all discounted cash flows. A best practice would be to create a cash flow diagram showing the magnitude of the future cash flows and their timing. There are two ways to approach this. Discount individual future cash flows using the Excel function or present value for each cash flow, or using the Excel NPV function, which is equal NPV, the rate, value 1, 2, 3, etc. The inputs to this are the rate or discount rate and the range of future cash flows. Be aware that one has to add the initial investment amount in year 0 to the result of the function. It is not included in the function itself. Excel has an IRR function that can be employed quite easily. The Excel IRR function is equal IRR of the range. Arraying the investment's cash flows in a cash flow timeline, one inputs the function range of cash flows, and the function will calculate IRR. In contrast to the NPV function itself, this calculation requires as an input all cash flows, including the year 0 initial investment. An NPV profile consisting of a graph showing the NPV results for investment over a range of different discount rates. This is a form of sensitivity analysis that shows how the NPV for the project varies with respect to the discount rate. The x-axis of the chart will show different discount rates ranging from 0 at the origin to the left and rising to the right. The y-axis of the chart will show net present value in dollars. The result will be a line starting high on the left, i.e. with discount rate of 0. The NPV will be high, and as the discount rate rises, the NPV will necessarily decline. The line will therefore go from the upper left toward the lower right corner of the chart.